Now Japan is at a crossroads. They have two options. Option number one, keep rates at zero, keep their high levels of debt manageable, and watch the yen get destroyed. Okay, watch inflation eat their retirees' savings. Basically watch a country of savers get poorer every single month. That option could eventually lead to a revolution. So you have option two, increase interest rates to save the yen. Now picking option two means that 200% of debt to GDP, that starts accruing real interest. The bond market that's been asleep for 30 years starts to wake up. The Bank of Japan, remember, owns half of those bonds. So they'll start bleeding losses on their own balance sheet. They need to start paying interest on their very high levels of debt. Now, there's no third option where everything stays the same way that it was before. So the option is save the currency or save the bond market. Okay, choose one. Now, what's interesting though is that Japan actually tried an option three where they increased their interest rates just a little and they intervened a lot, and they got the worst of both worlds. The yen started going down and bond yields started going way up. So both markets, their money and their bond market, broke at the same time. Let me show you what that breakage sort of looks like. First, I just want to say that this section is going to get pretty complicated, so stick with me because at the end of it, it'll make a lot more sense. But let me start with their money breaking, the yen. As I'm making this video, the yen is trading at about 160-ish yen per dollar, which is also the lowest level that it's been against the dollar in about 40 years. And the last time this was happening, Ronald Reagan was president and Nintendo had just come out. Banks like JP Morgan are saying that 164 yen per dollar is kind of like the magic line in the sand where Japan will supposedly not allow the yen to fall past. As of today, we are very close to that line, and depending on when you're watching this video, it could have already crossed it. So that's how their money's breaking. But now let's look at how their bond market's breaking. In 2022, Japan's 10-year government bond paid just 0.25%, very small amount. Today, it pays about 2.7%, which is more than 10 times higher in just 4 years. The 30-year bond is at about 4%. And I know that those numbers seem small compared to US interest rates, but remember, this is a country with over 200% debt to GDP. Every one of these percentage points applied to a debt of this size is a huge amount of money and interest. But Japan also has a weird paradox that's happening. Last week, two things happened in Japan on the same day. The first thing that happened was inflation came in at 1.6%, which is good. It's below the Bank of Japan's 2% goal. That happened for the 5th month in a row. The second thing that happened was the Japanese stock market went down over 2%, which is bad. That was about 30 trillion yen lost. And bond interest rates went up too, which is also bad. This is the opposite of what should be happening. Normally, when inflation comes in low, bonds typically do well, because low inflation means the central banks can relax. That's how it works in the US. But in Japan right now, inflation looks like it's under control, it's under target, but interest rates are still going higher, which is not good. Why? It's because Japan's bond market is not trading on inflation anymore. It's trading on a scarier question, which is who's going to be buying all these bonds? Right? The government wants to spend more, but the Bank of Japan, which is the buyer of last resort that owns half the market, they're trying to spend less. Investors are looking at the supply and they're demanding to be paid more to hold it, right? Because it's more risky for them. They're like, I don't care what inflation does, pay me more interest. This is why the world's investors are betting against Japan with huge amounts of leverage. Check this out. You're looking at 18 years of hedge fund bets on the Japanese yen. This data comes from the CFTC, which is publishing actual disclosed positions by big hedge funds. What this chart is showing us is that when this line is above zero, hedge funds are betting on the yen. They think the yen will go up. When it's below zero, they're betting against it. So the lower this line goes, the more money is shorting the yen.